All right. What's up, tycoons? What is up, traders? Super excited for today's video. Going to give another update on TLT. We're going to look at a couple bonds. We're going to look at the S&P 500 index, SPY. And then we're also going to take a look at SKU, VIX, as well as a few other things such as the SPY-G and SPY-V chart, as well as XLU, XBI. And then I'm also going to show you guys some very important data sets about the 10-year, 2-year Treasury yield, all right, and also the 10-year, 3-month Treasury yield. Both of those are inverted and suggesting that the bond market is pricing in a recession in 2023. Now, the bond market is much more massive than the stock market, and everything that Jerome Powell is doing, along with the Fed, is directly impacting the bond market. So, bonds have been a much better trade and easier to trade off of the catalyst that the Fed is bringing and Jerome Powell is bringing with all of the interest rate hikes. Okay, so make sure to smash the like button and subscribe to the channel if you guys are new. It'll really help the channel out, and we'll go ahead and jump straight into it and take a look. Okay, so if this chart looks confusing, don't worry. It's not very complicated. It's actually pretty simple. I'm going to explain it to you real quick. So the main wave and count that we're tracking is this orange wave here. Okay, so we have an A wave down, a B wave up, a C wave down, a D wave up, and then an E wave down right here. Okay, your first wave, your wave A, is going to be noted by a 5-wave pattern. And then your wave B is going to be a 3-wave correction wave, right? So you have your impulsive 5-wave down. We have 1, 2, 3, 4, 5 indicated in this pink right here. And then we get our corrective wave, okay? And that's our ABC wave up to complete this wave B right here. And then your wave C is going to be another 5-wave impulsive move down, right? And we have 1, 2, 3, 4, 5 down. And then we got our D right here. And we're currently in the middle of our D wave, okay? We got an ABC up. And if we zoom in here, okay, something that's very, very interesting is that we exactly rejected our 61.8% retracement level. Okay, now the reason we use these three levels, the 61.8, the 50%, and the 38.2, is that these are the three most common retracement levels, and these are very well respected. A lot of trading is done, whether you believe it or not, is done by algorithms. Okay, these large institutions, they're programming the algos to buy and sell at certain levels, and also based off of economic data that comes out and gets released. That's why every time you see CPI come out pre-market, you're either seeing a massive move to the upside or you're seeing a massive move to the downside. It's because the algos are programmed to buy or sell based off of the reports that are coming out. But if we take a look, we can see, just all throughout this entire bear market and this entire year, we've been respecting the three main retracement levels, right? So here's our first example. And if you're not familiar, right, we're using this tool right here, the fib. And what you do is you connect your swing high down to your swing low. We come down, we retrace to the 38.2, get rejected, and head lower, right? We do the same thing again. We come down, we retrace up towards the 50%, and then we get rejected and head back lower. This is very useful for spotting a trend, right? And so currently we're in a downtrend, and we're going to keep remaining in a downtrend as long as we keep getting rejected at these three levels, right? So we come down, we retrace back up, get rejected at the 38.2, and head down lower. A reversal would look something like this. You come up through these levels and you're actually able to break through them. So as soon as we break through these levels, then we're actually in the process of a reversal, and the market could be trying to head up higher. Okay, so each time we've respected these levels and we've gotten rejected again here at the 50%. Okay, and look at exactly where we just rejected at the 61.8%. So the whole setup right here is very bearish, but I do think that there is a possibility we could get a Santa Claus rally, right? And if that was to happen, basically we have three major catalysts this week. Between CPI, Jerome Powell, and the rest of the reports that are going to come out. Okay, it's going to be a jam-packed week. If they come out dovish, or the reports come in soft, then that's going to drive the market up. Okay, and TLT has a gap up here, right, to about 111. Yeah, 111.53. Right, it wouldn't surprise me if those reports come out and we kind of get a little bit of an extended D wave here, right? And to where we kind of pull back a little bit, as we've already done. We rejected the 61.8, but we're holding our 50% level exactly, right? That's exactly where TLT closed. So, if those reports were to come out positive, and I do think that, starting the week out, I think that there's going to be a little bit of optimism heading into the market, and it wouldn't really surprise me to see this stuff creep back up and try to fill this gap up here to the top, maybe even extend slightly past it again if we get those bullish catalysts. But we have to think of the big picture, right? And so the big picture is not so bullish. So even if we do, instead of get an ABC correction wave up here, we could try to start a reversal, right? And do A, B, C, D, E. And if we do something like that, then we're going to have an impulsive wave to the upside, and we're going to avoid out this 5-wave pattern to the downside that we've been tracking. And we'll have to reevaluate. Okay. So, December is going to be a big month to reevaluate things. There's so many catalysts going on, and we're really at a pivotal point. Now, the main thing that, it has me saying that we could possibly, be going bullish, at least for the short term, this week specifically, is the MACD. Okay, we on our MACD, we have not gotten the MACD crossover in the MACD sell signal. If you don't know what that is, that's basically when the blue line crosses below this orange line. Okay, so if we take a look here in the past, we can see once the blue line crossed below the orange line and we got that bearish crossover, that's right around here. We had a sharp drop to the downside. Over here, when we get a MACD crossover, we have a sharp drop to the downside. Over here, when we get a MACD crossover, we have a sharp drop to the downside. TLT has been the leading indicator in the market, especially for stocks, and we don't have that MACD crossover yet. I did explain that we were in overbought territory and that this thing could pull back. And sure enough, we ended up rejecting our 61.8 retracement level and pulling back. So, no really surprise there, but that doesn't really tell us for sure that this wave D up is complete, right? It looks like a perfect scenario where it could be complete, but there's so many catalysts coming through that we could, propel higher, or this could just be playing out perfectly to our technical analysis, and we could just get a massive drop if CPI and Powell come out extremely hawkish. So the next thing I want to take a look at is going to be HYG. Okay, and HYG is actually the corporate bond ETF. And HYG, along with the S&P 500, as we'll take a look, we did get the MACD crossover, right? So we're seeing, the blue line is now crossed below the orange line. That's very important stuff, right? As well as we rejected this major trend line on HYG, just like we did in the S&P 500. Right, we've got this major trend line here to the top side. We've rejected it, and we're really holding right in between those major retracement levels right now. HYG has a little bit of a rising wedge, which is actually a bearish pattern. We'll take a look at the S&P 500 next, but I just wanted to show you guys how TLT has not gotten the MACD crossover. We have not gotten the sell signal yet. And again, that's been the leading indicator. So, on these other things, we could be seeing a fake out in HYG and the S&P 500, where, maybe it's faking out and giving a sell signal a little bit too early. Okay. Or TLT just has to catch up, and TLT is lagging and running behind the market, and everything else is already showing, the sell signals. It does look like we have a small head and shoulders forming here, right? So if I go ahead and draw that for you real quick, it's basically going to be looking like this, right? We have our left shoulder, we have our head, we have our right shoulder right here. And if it plays out right, like if we're going to break this trend line right here, we could expect it to come back down and look to head back down towards 73 on HYG. Now, as I said, we're going to go into the S&P 500 and take a look at the SPY real quick, the SPY ETF. Okay, we'll pull that up. And SPY is looking very similar to the other things we were just looking at, but there are a couple major differences. Okay. So, we're tracking that 5-wave pattern down in orange. Okay. We have our ABC up. And in this one, we have a much more bearish rising wedge, right? So we actually got the breakdown on the rising wedge here. Okay. And so, we're zigzagging in between these lines right here, in between these two trend lines. Okay. And we got the breakdown, we came down, it looks like we retested it here recently, and then the S&P 500 closed very bearish, but TLT is looking a little bit more bullish. Again, we also did get the MACD crossover right here, our MACD sell signal, and we're seeing that SPY is trading a little bit bearish. Now it kind of does look a little bit like a bear flag, right? So if we look right here, here's our flagpole, here's our flag, kind of does look like a bear flag. So, if we break this trend line here, we most likely could expect a move down towards this gap on the S&P 500 that we haven't filled. We went ahead and we filled this gap up here. So now we no longer have to worry about that gap, and we can actually go ahead and take it off of our chart, right? So we'll go ahead and do that real quick and get rid of this as we did fill that gap. Notice how, the trend has been bearish. Okay. We've rejected, this trend line here multiple times this year. 1, 2, 3, 4 times. We recently got rejected on it, and then we recently just broke the rising wedge. So, the S&P 500 looks more bearish, but TLT looks a little bit more bullish, right? It's showing a little bit more strength, and that could actually bring the stock market back up. Okay. Especially with all of these catalysts here, there's a lot going on. And so you don't want to be too aggressive to the upside or to the downside right now. You really want to let things play out and see, if the patterns we're tracking are going to be valid, or if we need to reevaluate and make, and track some new patterns along the way. Right. The next one we're going to look at is going to be the VIX. All right. Now the VIX is looking more bearish, but there's a slight, bullish indicator hidden in here that many people are not catching, right? When I see them talking about it. So the VIX is very one directional. We just want to highlight that real quick. And if we take a look, it basically goes in one direction for about a month to two at a time, right? So we're seeing, this bearishness in the VIX, the market's going up. We get a breakout. Each time we've gotten a breakout though on the VIX, there's always been a sharp pullback, right? And so this is when, kind of people get faked out. So, you see the market drop and then it looks like it's coming back to life, when the VIX starts puking, but ultimately it just comes up, drops, and then goes much higher, and it stays bullish for a month or two, right? So here's bearish for a month or two, and we have bullish for a month or two. We take a look over here and we see the same thing. Okay, now VIX is puking again. It's very bearish. Okay, then we get a breakout, it pulls back, and then we're bullish again for another month or two. We come up and we're seeing the same thing happen multiple times in the VIX. This is what I mean by it's very one directional, right? We're saying it here, trading like this for 1 or 2 months, and then we get a breakout, we get a pullback, and then it actually continues higher. If we look at where we're at right now on the VIX, this is why I'm saying I wouldn't be surprised if, we do get a little temporary Santa Claus rally or something like that to head into the year. But, overall, I think 2023 is going to be pretty bearish, or we're at least going to have a sharp drop in the first quarter, maybe second quarter of, 2023. Okay. And the reason being is, one directional, right? It's been going down, it's been going down, it's been going down. We got our breakout. The VIX has not pulled back yet. Each time that it's had a sharp breakout, it's pulled back and then continued higher, right? So I'm honestly expecting at some point for the VIX to be pulling back, and CPI and, all the catalysts this week could be the thing that causes the VIX to go back down, right? There's so many catalysts that it may cause the VIX to come back down. And, once that really wears off, and once that, sentiment of like, oh, okay, hey, well, Powell's probably going to come off dovish and we're probably going to get 50 basis points, right? Well, after that, then it goes back to what really matters, right? And it's going to be stock fundamentals. You're going to be looking at earnings, and, forward guidance. We're going to be having our earnings season coming here soon in January for Q1, or I'm sorry, for Q4 of 2022. We're going to be seeing those earnings, next month, in the coming months. And those may be pretty bearish, guys. I mean, there's a lot of bad stuff going on, right? We have like Tesla bad news coming out. We have Apple, shutting down the factories in China. There's lots of stuff weighing in on the market that we have to keep an eye on. Now, another thing that I really like to look at is skew, okay, SKEW. And it's best to actually draw this on the line chart, okay? And what we can see is the skew, which if you don't know, this measures, so the VIX measures volatility, and it basically just tracks the option contracts on the S&P 500. What skew does is it tracks out of the money protection, right? So if SPY is at 400 and somebody is buying 405 put contracts, those are in the money, right? So it tracks all of those. Skew specifically is going to be measuring out of the money contracts. And so what we can see here is that there was a sharp spike, and this was 2 Fridays ago. So not last Friday, but this was 2 Fridays ago. And we saw this massive spike in the skew index. And then what do you know, Monday and Tuesday, the following Monday and Tuesday were pretty bearish in the market, right? Since then, we've actually seen the skew index drop. And we already took the look at SPY, the S&P 500. which also has been dropping here recently and broke that rising wedge. But we're not really seeing people, going out of the money and grabbing out of the money protection, in that case. Again, if we're looking here, we have a MACD crossover on the skew as well forming. And, each time that's happened, the skew has ended up going down. And this is more of a bullish signal, suggesting that people are not really hedging themselves with out of the money protection on the S&P 500. The next one we're going to look at is SPY-G. Okay, we'll take a look at SPY-G versus SPY-V. And if you're not familiar with this pair, this is the S&P 500 growth sector versus the S&P 500 value sector. Okay. And so this is basically a way to measure market sentiment. So what we're seeing here is that in a bull market, growth is going to be outperforming value, right? So that means that this index would be going up. All right. In a bear market, value is going to be outperforming growth. So that's clearly what we've seen, right? This entire year has been a bearish channel. Okay. We actually do have a little bit of a bullish pattern forming inside of this bearish channel. So we do, I'm watching this to really see if growth is really going to break out and break the trend. It's indicated by these two trend lines right here to the top. It's a falling wedge opposite of the rising wedge. It's a bullish pattern. And if we do get a breakout, that would suggest that, hey, the market is actually more risk on. It's less defensive, right? Growth is more risk on. Value is going to be less, is going to be risk off. Right now, another way we can track this and measure this is actually XLU/XBI, which XLU is the utility sector. All right. And XBI is the biotech sector. Now, biotech is one of the most risk on asset classes there is, right? And it gets impacted a lot. Okay. Let's just say that by the Fed rates. The reason being is that these companies, most of the time, what they're doing is they're taking on massive amounts of debt in order to create, some type of biotech product that hopefully will, send the company into massive profits, and they can, be able to sell to big pharmaceutical companies. But until they get those breakthroughs, what you're seeing is that these companies are really having to take out massive loans, or they're having to dilute their shares to raise money. So what we've been tracking here on XLUXBY is going to be this triangle pattern. All right. And what we see is we actually just got a breakout, a retest, and a continuation up higher. So when you look at SPY-G versus SPY-V, we see that, growth is still underperforming value at a massive pace, right? So that suggests that overall the market is still very risk off. Okay. In this pair as well, we're seeing utilities with a breakout, right? And we're seeing XBI outperform or underperforming. So when this is going up, when this index is going up, or this stock pair is going up, it means that utilities are outperforming biotech. And that basically just means like, hey, a very risk off sector is outperforming a very risk on sector. So it's going to be really interesting to see what we're going to do, right, in these levels. If we're able to break out past here, okay, that's going to be very, very bearish for the market. And you're going to see utilities continue to rise, okay? But this is going to be a major resistance level. And if we get rejected down here and head back down lower, the market is going to be a lot more risk on. Now, there's a couple things that I wanted to show you guys. I have a slideshow. We'll go ahead and pull it up real quick. And what we're looking at in this chart, all right, is going to be the S&P 500. And then we have the National Financial Conditions Index and the Adjusted National Financial Conditions Index. The reason we're looking at this is Jerome Powell's main goal in all of this Fed tightening and raising the Fed fund rate is to increase is to basically tighten financial conditions. And when we see financial conditions hit a peak, right, what we're actually seeing is a temporary bottom in the stock market. Okay. Now, specifically, if we look here, right, this is our financial conditions. We're seeing it come up here and hit a peak, right? And shortly before that, the S&P 500 actually bottomed. And then as this starts to decline, you're seeing the S&P 500 rise, right? And look at this level that we're at right now, okay? When financial conditions bottomed here in about August, right? That was the end. That killed our summer rally, okay? This is the peak here in August that we got, and financial conditions bottomed out right here. And then we saw a reversal. We saw these financial conditions start to go back up, and we saw the S&P 500 head back down. Look exactly where we're at right now. We're at this previous support level where the last rally ended. So, the last rally ended, here, we're much lower than that. Okay, so this rally hasn't been as strong, but we also did start from a lower point than we did over here, but the financial conditions are exactly right here. Again, his goal is to raise, is to basically tighten these financial conditions and make it harder on the economy. And overall, that should bring inflation down. That's one of the ways they want to bring inflation down. So it's going to be really interesting to see if we're at a possible peak. Now, if we break through this level and financial conditions continue to drop, then we're going to see the S&P 500 continue to rally. Okay. We'll go on to the next slide real quick. And this is what I was speaking about with the treasury yields. Okay. And this is the main indicator since the 1950s. I think in 1955, when you have the 10-year, 2-year treasury yield spread and the 10-year, 3-month treasury yield inverted. And if we look at both of them, they're both inverted. Okay. They're both, the 3-month is down 0.8% and the 2-year is down 0.83%. This is predicted a recession every single time. So 2023, most likely we are due for a recession. Even Jerome Powell and the Fed said in their last Fed minutes meeting that their base case scenario, which is basically not a recession, is almost the same as us getting a recession. So what they're saying is, hey, we're not good at predicting things, which they never are, but it's a 50-50 chance. We're either not going to have a recession or we're going to have one. And that's basically a coin toss. So, they're not really giving us any good info, but they are basically just increasing the possibility and the chances to the public and letting everybody know, hey, well, there's about a 50% chance that we actually could have a recession in 2023. They're not going to come out and say there's a 100% chance. And you have to keep in mind, they're pretty much wanting to cause a recession so that way they can get inflation down and really tighten these financial conditions and bring the job market down as well, the labor market. So if we look here, okay, we can see again, looking at these yields, and each time we've come down. All right, and we're looking at the 10-year, 2-year, and the 10-year, 3-month with the S&P 500 again. So the S&P 500 is here in orange, and we can see every time these come down and get inverted, what do we get? We get a massive crash in the stock market. Now it doesn't happen immediately, right? So look here, it takes a little while for it to develop. Okay, over here, this one actually happened pretty quickly afterwards. Right here, even, and then over here. So you can basically just see, once this thing starts to bottom out, you're really going to look and see the S&P 500 be dropping here in the future. It's just a matter of time. Okay. So you have to keep all of the macro, in mind. Okay. Don't fight the Fed. Don't try to fight inflation, and just be prepared for the year of 2023, especially the first quarter. That doesn't mean we can't get a Santa rally. Okay, TLT still looks bullish. The S&P 500, HYG look a little bit more bearish. VIX is looking a little bullish, but we saw the signals and we saw the patterns that each time it breaks out, it actually needs a sharp pullback and then a continuation up higher. So there's a strong possibility we could finish the year out bullish. But that really just depends on all of these catalysts that we have upcoming. Okay, they could completely wipe out the bulls. The Jerome Powell could come out super hawkish. CPI could come out super hot, and that would really just crash the market. And it would align perfectly with our 5-wave structure to the downside that we've been tracking on TLT and the S&P 500. So appreciate you watching this video. If you made it this far, smash the like button, subscribe to the channel, and I'm out.